Brisbane prices are predicted to catch up with Sydney and Melbourne. My name's Luke. I talk about all things real estate, renovating and financial freedom. Welcome back to my channel. Let's dive into this recent article talking about the Brisbane market. And I'm going to break down my thoughts on what I think about Brisbane, what the future growth prospects look like in the Brisbane market, and are we really going to see Brisbane catch up to Sydney and Melbourne prices anytime soon? So Brisbane property prices will start to catch up to Sydney and Melbourne regardless of what happens with inflation and interest rate rises. An upsurge for prices in the Queensland capital is tipped as an outcome of 4 2022 scenarios released by SQM Research in Christopher's Housing Boom and Bust report. The forecasting showed property prices would slow next year, agreeing with the Big Four banks' predictions. However, some cities would fare better than others. Brisbane would record the largest dwelling prices growth in 2022, supported by expected strong interstate migration flows and relatively good housing affordability. The price falls will be led by overvalued houses in Sydney and Melbourne, as they were sensitive to even minor intervention by the banking regulator, APRA. Before we dive into these scenarios, we are hearing a lot at the moment. I'm getting asked all the time in my job as a buyer's agent, what do you think is going to happen? Tell me, Luke, what the growth is going to be in the market. Give me your crystal ball gazing. Now, I can definitely talk to what the economists are saying, but at the end of the day, Emily and I have always been long-term buy and hold investors. We always hold to the point that we don't know exactly when the market is going to have its big booms, but you need to be in the market and ride the market over a long period of time to see consistent long-term growth. Now, typically the way property booms occur is a big spike like we've had this last year in 20% growth, and then they mellow out and continue at smaller rates over a long period of time and have another decline phase and then move to another boom phase. But all in all, that averages out to growth anywhere between 5 to 10%, depending on what location you're looking at. I know Brisbane has long-term historical growth rates around the 8 to 9% over a long period of time, but Emily and I try to be conservative and run 4 to 6% on our property portfolio and take anything as upside. Really, when it comes to property investing, it comes down to your attitude as to how comfortable you are with making a property purchase. And Emily and I always try to be conservative and then are happily surprised if there's greater upside than what we expected and what we conservatively ran the numbers at. So in terms of forecasting, I know the big banks and economists have really gotten it wrong because they couldn't predict what was going to happen from the federal government in terms of printing money and allowing easy access to cash. And these predictions are based on this point in time. Future predictions and future occurrences in our market, say a continued outbreak in the health crisis or changes in fiscal policy, all these sorts of things could change the economic forecast of any location at any point in time. Really, we're making a calculated risk, but what I see happening is that Brisbane is going to have another good run of growth in 2022 and potentially pull back and slow down in 2023 and then continue to increase out towards the Olympic Games. Now, of course, this is just my personal opinion and not financial advice, but let's read on and see what these scenarios look like in terms of what other people are thinking is going to potentially happen in the property market. So, scenario 1, the cash rate could remain unchanged, quantitative easing might scale back, and headline inflation at 3 to 5%, and further APRA action would happen by June 2022. Scenario 2 is where the second half year cash rate rises from 0.25 to 0.5%, which is fairly reasonable, and quantitative easing would scale back, headline inflation at 4 to 6%, and further APRA action would happen by June 2022. Scenario 3, the cash rate would remain unchanged, quantitative easing to scale back, and 3 to 5% inflation and no APRA action. And scenario 4, cash rate rise again to 0.5%, quantitative easing to scale back, headline inflation at 4 to 6%, and APRA action in March 22. So really, these scenarios are pretty similar. They're expecting inflation between that 3 to 5% or 4 to 6% mark, and APRA action at some point in the next 12 to 18 months, and then a cash rate rise between 0.25 up to 0.5% at some point in time. So let's take a look at Brisbane and then we can take a look at other locations around Australia. So in all of these scenarios, they're looking at a minimum of 3 to 6% in the worst case scenario, and 9 to 16% in the best case scenario, with 8 to 14 being in the middle. Now, I think that's pretty bullish, and these are forecasts, so don't take them as gospel, but it's really interesting on how bullish people are on Brisbane at the moment. I know I'm a Brisbane specialist in terms of our buyers agency, so it's been great that it's been busy and everyone's looking to invest in Brisbane. But I also want to people to take a word of caution as well, and make sure you take a true assessment as to why you're investing in the Brisbane market. Are you looking to jump on the hype train, or are you really looking for a long-term, solid investment that's going to give you potentially growth as well as cash flow over the long term? So definitely keep that in mind. Now, doing it around the grounds on these scenarios against other cities, you can see that Canberra is also expected to perform pretty well, and Sydney and Melbourne are expected to not perform as well, with in some scenarios having a pullback based on these forecasts, or doing in the low percentage points of growth if all things go well. Now, the other one I'd like to talk about is Adelaide, which has potentially forecast between 1 to 11% growth depending on the scenario. I quite like the Adelaide market, but Adelaide and Perth would be the other locations that I would be seriously looking at if I was looking for a major capital city with long-term growth perspectives and looking for a value-add opportunity, or looking to buy a good parcel of land in good proximity to those CBDs as well. Now, of course, I'm a Brisbane specialist, and the bulk of our portfolio is in Brisbane, so I'd recommend Brisbane, of course, too, but it's totally up to you as to where you want to spend your hard-earned cash. So the modelling also predicted home prices in regional Australia would correct, particularly for inland communities, as people return to the capital cities. This is a really interesting point. There's been a lot of talk around moving to the tree change and people going rural, but is there going to be a pullback of people wanting to go back to the city once the cities open up and we continue to have time at restaurants and go back to those lifestyle opportunities? Will people really want to stick it out in the country? Only time will tell. Now, in terms of buying in regional locations, I would be definitely looking at the large opportunities like Toowoomba, Coffs Harbour, all those locations that have large communities and large populations. I really wouldn't be looking at a location with less than 50,000 people. So if you're looking at a Bendigo or a Ballarat as well, those are potential opportunities if you're looking for a more affordable price point with some growth potential down the track as well. So something to keep in mind. Meanwhile, rent would rise in all capital cities over and above the Consumer Price Index. SQM Research Managing Director Lewis Christopher said that the housing market was already showing signs of passing its peak. If the Australian housing market does not slow down by mid-2022, APRA will likely keep intervening in home lending until the market slows down. We cannot afford another year of 20% plus gains across the national housing market. And so, to ensure a soft landing for the market, it is best we see additional intervention sooner rather than later to rein in property valuations. The RBA has said interest rates were likely to be on hold in 2022, but APRA intervention could occur as early as next month. Now, I think those are some wise sentiments, and that everything they've said there is pretty reasonable. We don't really want the market to run away and have 20% growth year on year. We definitely want to see the growth pull back because we don't want the market to get too hot and come into this big bubble that everyone's talked about. So we'd like to see it pull back or slow down as well, and then have a slow run of growth over a longer period of time. It's unreasonable for people trying to break into the market if you're a first home buyer or a new investor. So it's important to be aware of these economic considerations, but also dive into the suburb and location specifics as well, and look at what those growth drivers are going to look like, taking these economic factors into account. Now, is APRA going to intervene sooner rather than later? And are rates going to rise sooner rather than later? The talk is between the big banks and everyone out there that the interest rates are going to increase in 2023, and we've definitely seen that with fixed price interest rates increasing recently. And I think this is really, the market sentiment is that the market's going to slow down, have a bit of a pullback in the next 2 years, maybe see some great growth in 2022, and then pull back in 2023. If you're interested in using my services as a buyer's agent, make sure you reach out for a free strategy session where we chat about your situation and what we offer in our buyer's agency. If you want to see more videos on real estate renovating and financial freedom, subscribe to this channel, drop a like on this video, and click this video over here for one of those videos. I'll see you in the next one. Peace.